So sellers that are selling right now aren't selling because they want to sell. That's the narrative they're hoping that you believe. This buyer, I mean, the seller that we're buying this asset from, it's like, yeah, it's just a time for us to liquidate the asset. Interesting. How long have you guys had this fund? Oh, 20 years. Interesting. Like, what is going on? We'll never know.
Welcome to the Cash Flow Chronicles. I'm your host, Jonny Cattani, and the founder of Cattani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Welcome to another episode of the Cash Flow Chronicles. I'm your host, Jonny Cattani, and do I have a special guest for you today? I have to say, 300 interviews in, and I still remember hitting record for the first time and looking forward to this exact episode. My guest today is the founder and managing principal of Asym Capital, author of Raising Capital for Real Estate and Amazon bestseller, host of the Cash Flow Connections Real Estate podcast, over 1.5 million downloads, more than $75 million raised, and the founder of Raising Capital. He's a mentor. He's a friend. Mr. Hunter Thompson, welcome to the show.
Thanks a ton. And by the way, it's RaiseMasters.com. Got to put some respect on the name.
My bad. Founder of RaiseMasters.com, which is your newest venture. And
that's right.
We'll get into. Very excited for today's conversation. Before we get into kind of all the fun stuff, let's get a quick, I actually don't know if I know this story, but give us kind of the quick how you discovered real estate and kind of what's led to everything up to now.
So first of all, dude, I am so impressed with you, man. You have just let it rip, and it is so awesome to see. And the space of content creation and podcasting is, you have to be able to see the future and you have to be patient. And I think people know that when they get started, but very few people actually can do it in the moment. And just the fact that you've done 300 episodes in the short period of time that I've known you is completely insane. And, you know, I don't do a lot of speaking engagements, as you know. Usually I say, well, I'm not going to do it unless you've done the show for a year or 100 episodes. And normally people don't make it. So I don't have to say no, you know, it's like they know the rules, but here you are. And I'm super freaking stoked for you. And I know it's paying off for you now. And you put out so much great content. And I'm sure your listeners are very grateful. And I'm sure it's been great for you for networking. I just want to start off by saying that very few people take the kind of action that you've taken. And man, in 3 or 4 or 5 years, dude, it's going to be just incredible for you and your family and your future and for your listeners. So congratulations, man.
Thank you. I really appreciate that. Yeah, definitely wouldn't be here without you. I've talked, probably my listeners are probably tired of hearing about Hunter and Adam and RaiseMasters, but I'm extremely grateful, of course, for everything you've done and continue to do for me. So I'm really stoked to have you here.
100%. So you asked a question in there, but I kind of interrupted you. What was the question you wanted me to?
Yeah. So kind of your Genesis real estate moment. I don't know if I know this story of when you kind of discovered real estate. I know you've never been like a W-2 guy. You've kind of done other things. So kind of talk about how you discovered it and kind of what's led you to here.
Yeah. And just so people that don't know me know, when he means kind of done other things, that means no one would hire me. So let's just be real about that. So it wasn't a choice, right? So I very much was born just blood of an entrepreneur. The moment I understood that, you know, if you could figure out a way to kind of take advantage of supply and demand and make money, I just was obsessed with that. My parents lived very close to a stadium in Memphis, Tennessee. And every now and then, maybe like 3 times a year, there would be an event at the stadium that was so large that people couldn't park just in the stadium parking, and they would start parking by nearby neighborhoods. And it was a common thing in my neighborhood to like sell parking spaces in your driveway. And I remember doing this. It was like $5 a spot. And I remember getting $100 and was just like, we are rich. Like we can buy anything, right? I remember, especially as a kid, like a toy, which is like your whole life. You can go to Toys R Us, dude. If you spend $100, even today, in today's dollars, you're getting like 30 things. So I was like, this is insane. The harder you work, the more money you make. There was something to that. And I just was always kind of obsessed with that. And I was super competitive as well. So obviously for high school and stuff, you know, that wasn't really my focus. I was very into running. I took running very, very seriously. I don't think I was as gifted as I took it seriously, in the sense that it was my identity. It was just 100% all I thought about. Every waking moment was just running. And I was kind of like borderline getting to go and run Division 1, but I thought I was like a, you know, Olympic candidate. You know, that's how seriously I took it. And then that ended up not being my path. I did have opportunities to run in college, but I ended up going a different direction. And I'm grateful for that, because it eventually exposed me to business. One kind of important moment in my career was that, or my background, is that the poker boom happened around 2005 and 6 and 7. And for those that don't know, it was like like a $1 trillion boom happened in the poker industry. And it was really started by someone about 3 hours away from Memphis. So especially in Tennessee, this was huge. Some of you may know this story, but someone who's legally named Chris Moneymaker entered into a tournament. I believe it was $17. He was an accountant, full-time job. He won that tournament, which got him a free entry into a $200 tournament. He won that tournament, and it got him free entry into the main event, which is a $10,000 buy-in. So he took $17 and turned it into a $10,000 ticket. And then he won that tournament, which is against the biggest and best players in the world. And he won $1 million. And so this story, especially given his naming convention, it turned it into, you know, this massive boom in the industry, where it was the first time that I understood, if you took something seriously, if you took it more seriously than anybody else, if you got a coach. It was the first time I learned something really complicated on the internet. And like all that stuff was just really inclined to my personality. Now it's common to say, oh, you want to learn how to, I mean, that's a perfect example. You can go to YouTube now and learn far more about poker than I ever knew back then. But at the time, learning something that complicated, people wouldn't think, you know, 2005, it was just earlier in the internet. It wasn't that kind of second nature. Oh, you want to learn that, go to YouTube, learn that, go to YouTube, you know? So I ended up doing that, and I moved to California to pursue that as a summer job. Fell out of love of poker for obvious reasons. And then fell in love with real estate right when the crash happened in 2008 and 9. And so started taking real estate super seriously by 2010. And the answer to your question is that in 2010, you know, I had been all in on learning about finance starting when the crash happened. So CNBC, Jim Cramer, just like that was what I thought was like finance at the time. And it went all in on that, and Warren Buffett and Charlie Munger. But what ended up happening is that after all of the books I read, you know, nothing really prepared me for this European debt crisis, which happened in 2010. And so my thought process behind that was like, I don't know if this is legitimate, you know, like, I don't know, like, it doesn't matter how many books I read or how much time I spend listening to Jim Cramer. You know, all of a sudden you're telling me the greased bond yields are like the single most important determining factor of my entire net worth. It's like, what is going on? I'm a college person. What if I was 50? What if I was 70? And now you're thinking 30% volatility, and it's incredibly complicated. And even all these Princeton business school people couldn't have predicted this. You telling me I'm not going to be able to do this. So I really started just focusing on what's the most predictable way to produce cash flow for retirement. And I was honestly down for any asset class. It's just that real estate is by far and above the most predictable wealth creation tool in the world, especially in the United States, given the tax laws, the geographic locations, the fact you have access to financing, the fact that there's non-recourse loans. We take a lot of this stuff for granted. It's just really incredible in the United States in particular, which is why there's trillions of dollars flooding into the United States, or billions, I should say. And so it was clear that that's the direction I wanted to go. And that was kind of my last straw moment, was that European debt crisis.
Wow. That's wild. Yeah. And we're kind of going through something similar right now in our stock market, right? Crash happened. You know, I've talked about this almost ad nauseum about these retirees, like you mentioned, right? What if you're 50, 60, 70 right now, and your 401k and IRA are wiped out, and you don't have income to rebuild? You don't have that time on your side. And, you know, I don't want to say it makes it easier to talk about real estate, but I would say that people are more willing to listen about other investment, despite the fact they own a house and have all this appreciation. In real estate, as like, you talk to older people and they've, maybe on their third house, and every time they make money, and yet somehow you still seem to not be able to get through to them. But I love it. That's a great story. Did you start small, or were you always on the passive side? I know we'll kind of get to kind of your real estate journey, but did you always start passively, or did you start by buying a single family and house hacking, or what was kind of your first deal like?
So the moment that I kind of uncovered the casino-like nature of the stock market, and, this is around the time that Rich Dad, Poor Dad is starting to be just, everyone's talking about Rich Dad, Poor Dad. And I think that's something that Kiyosaki did an excellent job of. He was the first person that I saw really kind of debunk the financial advisor model and debunk significantly the mutual fund model. And from my perspective, he killed it. He killed the industry. Now, some people don't know that he killed the industry, and they're still going along. But being someone who's kind of inclined to these uncovering the truth about X, which I've been doing all my life, and I know you have as well, and many of your listeners have as well, which led them to you. That was like, are you kidding me? Most financial advisors cannot keep up with the stock market, and you can literally buy the stock market. You can buy an ETF that technically keeps up with the S&P 500. And mutual funds, 77% don't keep up with the S&P 500. And you're telling me you can literally go buy an ETF, which is the spider, and it just keeps up with the entire stock market. Whoa. Like, that's not some wild hunter is a crazy conspiracy theorist thing. That's like literally, that's not refuted. And they don't have to refute it because the marketing budget's so big, they don't have to answer the question. And so that was like, I got to get my mom out of this. That was my reaction. I got to find a way to help my mom get out of this. She had money in the stock market at the time, a lot of it. And I wanted to help her transition out of that and into the things that I was talking about, predictable cash flow. So when I went out to learn about real estate, the first meetings I would go to would be 2010. And, I'm very grateful because I know what it's like to go to a real estate meeting where everyone's got their head in their hands and they've got kids coming home from college unexpectedly, and they've got divorces happening, and they've got foreclosures happening. I know all about that. Now, I didn't go through that because I was just getting into the business, but I happen to know that this stuff can go wrong. And so I'm grateful that I wasn't 4 years older, because they were some very savvy people that were going through some difficult times. That was a very unique situation though. But the people that were able to weather that storm all had a very simple strategy, which was buy really high quality, large assets, sometimes with hundreds of tenants and millions of dollars of debt financing at, conservative rates, meaning big freaking properties with a lot of tenant diversification. And so, and also an inverse relationship with the overall economy in terms of the demand for that particular product. So mobile home parks, self-storage, and multifamily apartments in particular. And so I uncovered this strategy of being a passive investor, and I didn't want my mom to have to buy a property directly. I just wanted to find best-in-class operators in all of those niches and help her. And so I founded my company with one investor, my mom, and then me, and then 5 people, and then 100. And then now we have more than 500 over the last years, and have bought, hundreds of millions of dollars of real estate, not directly, but through our investors, of course, and have, allocated tens of millions of dollars to these various asset classes.
Wow. Okay. So you identified the kind of the commercial space initially, stay there. That's kind of mine too. I looked at wholesaling and fix and flipping, and it was just too transactional. I recognized that right from the start, and it wasn't for me. And so most people know you obviously as a capital raiser, right? You're easily, and this may be biased, I don't know, but you're definitely the best capital raising coach in the industry. And
thanks, man.
Obviously continue RaiseMasters, and now you've got Capital Collective. But one thing that I really, I latched onto, and why I ended up joining RaiseMasters, because you were in the mobile home park space and the self-storage space when they were like, people are like, those are literally tin boxes on a piece of concrete. Like, nobody's buying those and needs those. And now now it's an entire, multi-billion-dollar industry, and you've got all these players in both spaces, and obviously still raising capital. But a huge thing that's happening now is you've completely switched gears from only staying on the passive side. You've raised, like you said, tens of millions of dollars for other people, and now you're switching to the active side. So let's get into that. Kind of touch on the decision there and what your focus is and all of that.
Cool. So before I kind of transition, you're absolutely right. 2012, 13, 14, very few people were talking about mobile home parks and self-storage, but mobile home parks in particular. I wasn't the only person. I was trying to kind of stand on a rooftop saying, am I the only one that sees this? Like, this is an incredible business model, and the cap rates are higher, and the tenant base doesn't leave, and there's always demand for this product, and it's recession resistant. And so one of the things I'm most proud about in my career is if you search Green Street Advisors commercial real estate NOI growth by asset class, you'll see there's a chart that you can see. It'll take a moment to search it, but you'll find the mobile home park and self-storage business just crushing since 2012. And that was something that, I predicted, and many other people predicted as well, but it's just like NOI growth, that chart is just so telling. NOI growth isn't like I got lucky. NOI growth was like, it really was a predictable supply demand imbalance. And I'm really proud of that. Now, you can also Google my name and just search in my other calls, and they're not going to be that good, but that was a really important one. And the nature of the call is far better than, let's say, my view on interest rates, right? Much more difficult to predict and all the thing, but that one is just, I'm super proud of that. But my friends, there's more to it than just NOI growth. There's a lot more to it, right? And there's also, not just from an investor standpoint, from a business owner standpoint. So, not only is it NOI growth, what about the multiple on which that NOI is traded? So while the self-storage and mobile home parks did incredible in terms of that metric, what about cap rate compression? And you see multifamily apartments just crushing, similarly crushing. And I just, after doing deals in every single vertical across every single asset class that's popular, and even some non-popular ones, I just have found that multifamily apartments are just so compelling. And one of many reasons why is that there's so many players in the game. It's so liquid comparatively. And when you do well in real estate, everyone, talks about cap rate compression and incredibly high 28% IRRs net to LP investors. And I've had plenty of deals do that. But I happen to know that you can also lose money in this business. And the way you lose money in this business is you run out of people to deal with. And it can happen quickly, regardless of what's going on with the liquidity in the market. If you start with the really small buyer pool, start with the small lender pool, start with a small group of property managers, start with the small people that are competent to run construction, and then the market dries up, that small pool turns out into a no pool. So I want to do the opposite of that. We're going into Phoenix multifamily apartment. That's all we're looking at going forward. Just Phoenix, just multifamily. And the reason is a lot of buyers, a lot of sellers, a lot of friends to have, property managers, lenders, debt brokers, other operators that want to buy your property if something goes wrong, institutional quality, you name it. And so as a passive investor, sure, you may want to find an operator that's going to focus in senior living in the Northwest. And I encourage you to pursue that. But for me and my group, we just want to be super, super good at one thing. And also the underlying theme here is that, we've built something far more robust than I thought I would ever want to build. And so now we have a lot to lose. And so we're not willing at this point in our career to defer to that third party for something so material as, let's say, asset management, right? So that's kind of the story of my background and my career. And our vision forward is retaining more control, vertical integration, and buying that city.
Absolutely. I love it. We have the same goal here in Salt Lake City as well.
Cool.
Similar well, they're not that similar. Funny enough. Phoenix is pretty liquid, like you mentioned, relative to other markets, right? 2 to 3 year holds are very common there, whereas Salt Lake, it's not uncommon to hold an asset for an entire 10-year, agency loan all the way through. I want to backtrack a smidge. I'm curious, just really quick, how you discovered these very sort of nuanced asset classes, being mobile home park and self-storage back then, right? Because apartments have kind of always been the big sexy, right? And a lot of people want to get into that. They start small with duplexes and whatnot and kind of scale up. I know you've always been look left when everybody's looking right, which is another, trait that drew me towards you. But how did you discover it? Like, you said people were talking about it, but there wasn't a lot of mainstream back then.
Yeah. So I started going to real estate events, networking events. Most of them were kind of pitch fests where the goal would be, it would be a free event. You pay $127 to go to an event where they would charge you $997, go to an event where they'd charge you $99997, and then go to an event to just endless stuff. And at one of those events, I met someone who was doing ATM machines, and they were an operator of ATM machine business, a very small group where they placed ATMs in new retail centers, and the cash on cash returns were very high. And I was like, this is super interesting. Like, I don't care about real estate per se. I would just want the cash flow. So like, what's the deal? And he said, if you're interested in this type of thing, you should meet someone named Jeremy Roll. And he introduced me. I attended Jeremy's next meeting, and I remember clicking RSVP on meetup.com. And then like almost instantly, I got like a 9-paragraph, hyper detailed, personalized email from Jeremy apologizing because they weren't having the meeting that week. And for all the reasons that they weren't having it, but the fact that they rescheduled it for the next week, it was like the most overwhelming, ridiculous Wharton Business School kind of response. I was like, dude, it's all good. It's a free event. Like I'll see you next month. And I ended up meeting him, liking him a lot. And the cool thing about it was that very quickly, it was like we had a similar kind of foundational understanding of the way things worked, similar kind of worldview. And he was playing the game the way I wanted to play it, but he had just been doing it for like 7 years at that point. And so I just wanted to latch on to him as much as I could. And one of the things that happened with him is that I reached out to him and said, hey, I really want to help, my mom start allocating capital to these types of investments, but I don't know much, can you have an internship available? Can I work for you? And these types of things. And he was like, no, because like, I don't really need to do anything like that. Like, I don't have like manual labor jobs. I don't really do much. I just find good deals. And I was like, damn, that's exactly what I want to do. So I was like, okay, so maybe can we have a call like maybe once a month? And he's like, why don't we do it twice a month? And I was like, oh my gosh, done. And that we still have that call today. It's been 10 years. And trust me, I think he's gotten a good investment on that. But at the time, he didn't know where I was going to go in my career. He didn't know that it was going to be one of those relationships that would actually work out. And who knows how many calls that he had like that didn't play out. But I'm very grateful for that. And Jeremy and I are very different in a lot of ways, but he really helped me create the foundation of my passive investment career. And the cool thing is that, I don't know this, but you mentioned me as a capital raiser. I would consider Jeremy Roll probably the #1 passive investor in the country. So my first mentor ended up being probably one of the most influential and largest passive investors in the country. And so I'm super grateful for that as well.
Absolutely. Yeah. I was just going to say, for the listeners, I would definitely go research Jeremy. He's one of the great minds, especially I would say abstract minds, in the way that he approaches things is very different than obviously you've been to a lot more conferences than me, but you kind of start to hear the same things over and over up on stage. And it's very refreshing when he gets up on stage, and it's a very different perspective and view kind of on the industry and where things are going. And, like you said, definitely probably the #1 passive investor and proof that you can make a living and a career out of just being a passive investor. But that's awesome. I love that. That's amazing. Okay. So let's get into Phoenix. So in 2008, I was, just a pimple-faced kid, graduating high school, didn't pay much attention, obviously knew a little bit about what was happening. But if I understand correctly, Phoenix got hurt pretty badly in the '08 crisis and kind of vowed that it would never happen again, and has since worked really hard to put the infrastructure in place so that they're recession resistant. And that's one nice thing that Salt Lake City has is, you know, you look kind of quarter over quarter at the data, it's pretty sheltered. And there's some other markets that are as well, but let's talk about Phoenix, which is your top market. So first, kind of talk about why Phoenix, what you like about it.
So it's cool because just given my network and my background, my partner Tyler and I, who's the chief investment officer, we basically said, look, we're willing to look at any asset class in any geographic location. And we have contacts everywhere because of what we do. We place capital with these well-known sponsors. And so, or that's what we, previously did. And so we looked at self-storage, we looked at multifamily, we looked at those two in particular we were most interested in. And we looked in Florida and Texas and Arizona mostly, and also in the Carolinas. And at the end of the day, I really like Florida, but I have concerns around the hurricane thing. And I don't want my portfolio to be binary, right? I really want to stay away from emails that can wreck my day. And I've gotten some emails about those particular topics. Hey, guess what? It's happening. Your 10 asset, $300 million portfolio is in the middle of this nightmare. It's all heading right towards the East Coast. I mean, that's typical. If you're a passive investor, that's going to happen because that's a growing and robust market. So we wanted to avoid that risk. Texas is super compelling. Carolinas are super compelling, but we've already allocated more than 10 or $12 million to Phoenix. We have great relationships there. And look, Phoenix is the #2 fastest growing city in the country. And that metric is not, and that's in gross people moving, not percentages, right? So when you have these tertiary markets, you see some random city in Texas that you never heard of. Great, 30% population growth. It went from 100 to 130. That's not what we want to do. So I'm talking the people flooding that market. And that creates an incredibly pronounced supply and demand imbalance of housing, especially affordable housing. And you can just look at that one metric. And we don't just look at that one metric, but that one metric is downstream of everything you're talking about. What they put in place in terms of attracting Fortune 500 companies, what they put in place in terms of the overall affordability, the natural weather of the environment, what California obviously did, especially during 2020 to motivate people to leave permanently. It motivated a lot of people to move there, and people's moving to a new city, that's not a volatile metric. It's the furthest thing from a volatile metric. It's not like valuations went up by 20% and they went down by 20%. You don't see, 500,000 people move to a city and then immediately move away like a year later. That just doesn't happen. And so I can go on and on, but the fact that it's very competitive, I like. And I used to stay away from this, but now that I know a little bit more about operations and also marketing, which kind of fuels the whole funnel, I think we can beat these guys. You know what I mean? And I used to have a limiting belief that I can't do it. And I work with a lot of sponsors. I work with some incredible sponsors, and I'm like, yeah, man, they're freaking good. We probably do things slightly differently and we'll figure it out. And I've also worked with some sponsors that I was like, holy crap, like, that is an F, and that's not acceptable for our business. Right. And so what I mean by that, work with them, investing passively with them and such. And it's like, I've got a very broad spectrum of the industry, maybe more so than most people. And I can tell you that we can do it. And so and we owe it to our investors to do it. I never wanted to do it, but we owe it to our investors in terms of vertical integration, controlling everything. We want to make promises and also deliver on those promises. And that's kind of the story of both Phoenix and our vision. But I just don't want to run out of friends, man. I don't want to run out of friends. And especially so it's very difficult to get into a market right now, previously like Phoenix, but right now, every broker wants our phone number. Everybody wants to show us a property. And so this moment that I've been waiting for 5 years or so is now here. And you can, anyone listening to this, you can go all in right now. And trust me, in 2 or 3 years, you're going to be very grateful that you did.
Yeah, absolutely. I remember at RaiseFest telling Tyler that I was switching gears from, focusing like you did on the passive side and raising capital, which of course we'll always be doing, but to switching to the active side, specifically here in Salt Lake City. And then he mentioned that was your guys' plan as well, which only reaffirmed my decision as well too, because I was like, okay, if he's doing it, then I'm onto something here, which we are, right? You mentioned in a podcast that was just released yesterday at the time of this recording, but a lot of debt, floating rate debt, different debt pieces are really the most compelling part, in my opinion, to why now presents such an incredible opportunity. So kind of give your perspective there as it relates to the decision.
So every major challenge in real estate is related to debt. And what's going on right now is particularly related to interest rates. Obviously, interest rates have risen, especially in these competitive markets where in order to make deals pencil, it was a requirement that you would take on floating rate debt, usually with short terms, because if not, it's going to be difficult. Unless you have a very low cost of capital, it'll be very difficult to compete with other buyers in the space. So what I'm anticipating right now is that a lot of this bridge debt is going to come due. And there's going to be pain, not with the kind of sponsors that we've invested with previously, but we all know the popularity of the space has increased drastically. There's people who bought their first deal in 2020 or 2021, and they don't have the track record, the buy-in of the clients to weather the storm. And so we do, and we're well capitalized, and we're going to take advantage of that. So, however, looking at it from our view, we would have and did buy assets in those timelines. And I'm happy that we did. I'm super confident. I'm comfortable with those assets. We're confident we can weather the storm, working with operators the caliber that we work with. But man, if you would have bought that property at a 4 cap, certainly now we could buy the property at a 5.4 cap. And how good are we going to feel over the next 2 years? And that literally happened. There's a property that we are about to purchase that is exactly that, where there was another property right down the street that sold at a sub 4 cap. It's not quite as nice. And now we're buying this property at a 5.4 cap. That is a huge difference when it comes to protecting and padding your equity. So people may say, oh, it's about to get worse. I have seen enough to know that it doesn't, you might be right. You might be right, but padding a 20% on your buy, that's about as good as it gets in this business. And so maybe it'll be 20%, maybe 25, maybe 30, and we're going to be buying during all of that. But you got to start now because you want to be capitalized and also have the relationships that are capable of facilitating that. So we're super excited. The 5 and 10% stuff, that's not really consequential, but buying discounted assets is super consequential because we owe it to our investors to allow them to maintain their investment, to keep invested.
Absolutely. Wow, that's some pretty significant decompression, which is kind of what we all anticipated happening, I think, as interest rates just absolutely skyrocketed. It was kind of long overdue. It really felt like we were waiting on that. One of two things, either seller capitulation, which I still feel like hasn't really happened, or literal forced sell of an asset due to debt, which is what is happening now. And Phoenix skyrocketed so much. Like you said, so many brand new groups got in there, bought their first assets, 20, 21, all that floating rate stuff. Rate caps were not really even a consideration unless the lender forced you, which not very many lenders did, because nobody anticipated 2 years later that interest rates would be double, 2.3x basically. Yet here we are. And it presents a great opportunity for folks like us who weren't over leveraged or, are well suited. So a question I have is, obviously a huge shift for your investors. What's been the response from your investor base?
Well, we haven't really talked about it directly with our investor. That's why I wanted to do this interview. I wanted to share this, and I'm going to send this out with my audience if that's okay with you, because we have kind of slow played it. And one of the reasons, I don't want to go down this whole rabbit hole, one of the reasons is that the vertical integration component, we see an incredible opportunity, a rare opportunity to get discounts in a hyper competitive market, but also the compliance element of being licensed and under a broker dealer is very difficult. And the broker dealer that we work with, this is not anything against them. In fact, very much the opposite. They know what they're doing. And what we've uncovered is that this is a difficult to navigate space, not set up to help people invest 50K or 100K or $250,000, far more set up to help people invest 20 million, 50 million. It's just not worth it to go through that. And so, think about it from our perspective. The same level of compliance to help someone invest 100 grand is what these Goldman Sachs companies are doing. So like, we just simply don't have the infrastructure capable of just going through that level of detail. And a broker dealer, why would they want to deal with us doing 4 podcasts a week, doing $4 million raises versus the same level of compliance for a $4D million raise? So it's just not a good fit. And this is just my opinion. If you are a registered rep, it's nothing against you. There's different people have different perspectives on this matter. And just, we have been through the rabbit hole enough to know that for us, given all the matrix of things I just talked about, this is the best opportunity for us and our investors by far.
That's awesome. I love it. Well, I'm excited to watch. Obviously, you guys already have one under contract. We're working on a couple here as well. It's an exciting time. I'm really excited. Like, this feels like as close to 08 as we're going to get in terms of the opportunity, and looking back 5 years from now and being like, holy cow, like, I'm really excited. And I was talking to, obviously John Pearl. I've talked to a few other RaiseMasters members about how exciting it is to be getting in now, in terms of, you're obviously not new to the industry, but as a new person to the industry, and having to learn to navigate right now,
Yes.
right? Raise capital in this, underwrite deals at a 65% LTV, and understand how it works, so that when the 70-80% LTVs come back, you're just already, wheels are greased and you're rolling. So
Totally.
It's a really, really exciting time. Real quick, give us kind of your muddy crystal ball of what you see for the next kind of 12 to 18 months.
Well, transaction volume has fallen off a cliff because no one knows, and there's not enough pain to liquidate assets at what buyers are willing to buy them for. So that's always what happens when corrections happen. And then it becomes a requirement, or it doesn't happen. So, and I say that because there's this new button that exists now, and starting in 2008 or so, where it's like, hey, the economy's shut down, it's illegal to go to work. And we're like, oh my gosh, this is the moment we've been waiting for. And then the government says, and we're going to smash a $2 trillion button domestically and another $8 trillion button globally. So congrats, no work, no discounts, nobody can be evicted. Nobody, like, that was a crazy situation. I don't want to say that can't happen again, because it can. But given the nature of this, which I'll go into a little bit of detail here. So, energy is really drastically increased. Energy is the underlying metric of all economic movement. We must have energy to have any sort of technology or correspondence or anything like that. So when those prices increase drastically, you're going to see inflation. Now, you also compound that with that $10 trillion button that I talked about before, and you also compound that with the supply and demand imbalance in housing, and you get significant inflation, and historically significant inflation. But to combat that, the Fed has been raising rates with the intention of combating inflation and also maybe cooling off the economy. That is why this opportunity is happening. So I don't think the intention is, I should say, restate that. The intention is to cool off the economy. So I wouldn't see, hey, we're raising rates to cool off the economy, we're raising rates to cool off the economy. Oh no, the economy is cooling, let's smash the $10 trillion button. I don't see that narrative playing out this particular time. So I do think transaction volume will happen again. And it's just a matter of what the loan to values will be, what the interest rates will be. Once those things level out, then buyers and sellers will get together and you'll see that transaction volume happen, most of the time under duress. So sellers that are selling right now aren't selling because they want to sell. That's the narrative they're hoping that you believe. This buyer, I mean, the seller that we're buying this asset from, it's like, yeah, it's just a time for us to liquidate the asset. Interesting. How long have you guys had this fund? Oh, 20 years. Interesting. Like, what is going on? We'll never know. But like the fact that they were like, yeah, this is a good time to liquidate. We'll never know what the pain is coming from, but we're going to just scoop it up. So there's going to be more of that. And then there's going to be some people that say, hey, this seller is interested. He's poking around. And then the brokers are going to follow up and say, you guys want to throw an offer in? And then they're going to say, hey, listen, I know I said 19 million, but like, what would work for you? 15? Okay. What do you want to send an offer in for 15 and just see what they say? That's the conversation that's going to happen. So we'll see.
I love it. That's awesome. Cool. Well, we'll go ahead and wind down here. We'll jump to the final 5. First question, best advice you've gotten from a mentor?
Dang. I'm a big fan of Alex Ramosi. And I think that if you're listening to this podcast and you are a passive investor, what you should do is go all in on making more money the way that you can make more money, and use passive investing as a tool to grow your wealth, to funnel your income into passive investments. Don't think of passive investing as your job. And this is something that I've had a little bit of a change of heart about, but you will do if you're a physician, for example, figure out a way to open up a new facility or something like that. That will give you a material impact in your net worth situation. And you can just funnel that money into your passive investments. On the other side of that, if you're an owner operator, stop thinking like a passive investor. Stop funneling money into these deals that are going to generate a 15 or 16% IRR. That's the kind of return you get as a passive investor. It's passive. So don't work your butt off searching for this 16% IRR. You should be stacking cash for moments like this to invest not in recession-resistant real estate, but to invest in total employees that are rock stars that will fight for you to the death. Then we're not talking about 15% IRR. We're talking about 100% IRR annualized. So that's a dichotomy that I think people need to understand. So think about it like that. You're a physician, dude. Hire one of those employees. And when you're starting to stack money, hammer it into these passive investments, and don't try to spray and pray. Go all in on a couple operators that you trust, because when you spray and pray, your due diligence goes to the wall and you're just chasing a kind of shiny object. That was a lot of information, but that's my answer. I'll be more brief on the next one.
I love it. No, that's incredible advice for sure. What is about your career that makes you feel like you're fulfilling your why?
Ooh, bro, you were at RaiseFest. That was one of the coolest things I've ever been a part of. And if you're interested in learning more about that, you can go to raisefest.com. I have done a bunch of different interests in my life. I really was into music. I was in a band. I used to DJ. I also have a podcast. I love to speak. I love to raise capital. RaiseFest was like the culmination of all the things I took super seriously in my whole life. And it was just exactly what I wanted to create. And it was the first year ever. Our goal was to sell 390 tickets. We sold 530. The place only could hold 500. It was a complete wild moment of success and community, and tears were shed and capital was raised. And that was the answer, man. That's the answer.
I love it. And it speaks volumes about, your reputation in the industry, that you can get people to go to Louisville, Kentucky in January.
We are going to Phoenix next year.
We are going to Phoenix next year. Absolutely. Yes. Very excited for that, for sure. Favorite non-real estate or investment related book?
Well, I'd have to say Double Double was the inspiration for the way that I wrote my book. It's Double Double by Cameron Herold. That's one that doesn't get enough shout outs, but I think that's the answer. It's about business.
I don't even think I've ever gotten that answer. So I'm going to put that on the list. If you could have any superpower, what would it be?
This is easy. God, I'm sorry I can't be short-winded, but you got me on here. So I just got to be myself.
Please.
So I'm in the business of getting results. And that's why I have kind of trying to take the path of least resistance in all of my pursuits. And so real estate is probably the most incredible wealth creation vehicle. So that's where we are. Capital raising is one of the most incredible skills and most lucrative skills in the world. Marketing is one of the most lucrative skills in the world, but they are nothing compared to inspiring others. End of sentence. If you can inspire others, you can do anything, because you can inspire others to buy real estate for you. You can inspire others to raise capital. You can inspire others to die for you. You can inspire people to go to war with you. And that is the multiplier. So now we're playing a game where it's real estate, capital raising, marketing, plus inspired community. And you see what happens.
Yeah. Wow. That's awesome. That's extremely powerful. Right. And again, speaks volumes to your reputation and what you built. And it's been incredible to be a part of. I'm one of the OG RaiseMasters, grandfathered into a price that we'll never see again. So I tell people, I was like, I think I'll be a RaiseMaster forever, just out of principle.
Well, just for context for people that don't know, because there's going to be a lot of passive investors listening to this. So we have a coaching program for capital raising clients, people that want to raise more money. And our goal was to have 35 clients at the end of the year. Our goal was to have 50 clients at the end of 3 years. We hit 430 in 2 years. So we got it right. And the thing we got right, though, was inspiring others.
Yes. Yeah. And one thing that I appreciate so much about you, and we'll get to the last question here, but one thing that really, the final thing that really drew me to you and signing up was your no BS, right? Like, of course you love to have fun, right? Raise Fest. I mean, it was a party, right? And you love to have a good time. I mean, when we go on our retreats, there's always some kind of bar crawl or something in the itinerary. But when it comes to business, one thing that I love so much is people who just don't fluff time. They just, this is what I have to say. This is what we're going to do. And this is how we're going to do it. And you can tell that that attracts a certain mind, right? And I know you talked about how you have there's so many doctors and engineers in RaiseMasters, and that's how they think, right? They think in that, like, I need to be as efficient as possible with my time. And that's one thing that I love about it. And it's been amazing. And I've talked to death about it on here. So it's great to finally have you. Final question though. What's the best way for people to get a hold of you and learn more?
Yeah. So if you're a passive investor, you want to learn more about Asym Capital, all you got to do is go to asymcapital.com. And at the top, there's a thing that says, book a call with us. We just recently put that up. And if you want to get connected directly to my chief investment officer, we're doing this now because we built something a little bit more robust. And I think it's a good way for people to get connected. I mean, he's a senior financial analyst, a background with a publicly traded company as an accountant, very savvy person. And you'll be super impressed. If you are a capital raiser or you want to be, go to raisingcapital.com.
Shout out to Tyler. We'll link those in the show notes. Shout out to Tyler. Tyler's amazing. Always love chatting with him. Hunter, I honestly cannot thank you enough from the bottom of my heart. Obviously for your time here, but man, there aren't words to describe how grateful I am for everything, because all of this is not all because of you. Obviously I, had to take the action, but your kind of nudge over the edge is what set it in motion. So thank you very much.
I super appreciate it. And I don't take credit for it. You know what I mean? Like I know what you mean by that. And like I said, the difference is these things that I say to do are not easy. And so as much as I want everyone to just do it, few do, but it's not easy to do. So I know how rare it is. And that's why I said what I said, and just keep it up, man. Just keep it up. There is going to be some really difficult times, but there's going to be times that are so difficult you can't possibly imagine it. If you continue on the route that you're going for, because you're going to be faced with challenges by necessity, you will feel like you're not capable of overcoming. And that's the nature of growth. It's going to be very boring for you if you face these problems again in 4 years, trust me. But what that means is that there's going to be some issues that you feel like there's no way you're actually capable emotionally, financially, relationship-wise of dealing with. And just try to remember this conversation, because you are, and it's a logical necessity that you are, because the only way to get into those challenges is to get yourself into those challenges. So if you can work yourself into an issue, whatever got you into that position is what allows you to participate. You can't skip it. You can't skip to a new level without being able to skip to a new level. So keep it up, man. Don't quit. And this industry works. So go for it.
Thank you. I appreciate that very much. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to CataniCapitalGroup.com to learn more.